Hey everyone, welcome back to Corporate Decoder, the place where we decode the language of big business. Today, we are diving deep into Nortech Systems Incorporated's latest quarterly report. Get ready because this one has some interesting twists and turns that might surprise you. And hey, if you like getting straight cut insights from these massive financial documents, don't forget to hit that subscribe button and join our Discord community link in the description below. Scroll Nortech Systems Incorporated and subsidiaries condensed consolidated statements of operations. Scroll let us start by looking at how the company performed financially. For the 3 months ending the 30th of September of 2025, Nortech Systems brought in $30,482,000 in net sales. Now, that sounds like a lot, but it is actually a step down from the same period in 2024, where they had sales of $31,407,000. When we look at the bigger picture, the first 9 months of 2025, sales were $88,052,000. A noticeable drop compared to $99,513,000 in the same 9 months of 2024. This dip in sales, especially in the aerospace and defense sector, seems to be linked to some customer approvals taking longer than expected, and also some big moves as they shifted production between their plants. But here is where things get a little more interesting. While sales went down, their gross profit actually went up in the 3-month period. For the 3 months ending the 30th of September 2025, gross profit was $5,025,000, a good jump from $3,835,000 in 2024. This is likely because they are managing their costs better, and some of the restructuring efforts are starting to pay off, leading to improved efficiency and a better mix of products being sold. The gross margin percentage, which is gross profit divided by net sales, also went up from 12.2% in 2024 to 16.5% in 2025 for that 3-month period. This tells us they are making more money on each dollar of sales. On the flip side, selling expenses did tick up. For the 3 months ending the 30th of September 2025, selling expenses were $1,221,000 compared to $891,000 in 2024. The company mentions this increase is partly due to some organizational changes where customer-facing managers' roles were shifted from plant operations to business development. So it is not necessarily that they are spending more to sell, but rather how they are categorizing those costs has changed. General and administrative expenses, however, showed a welcome decrease. They fell to $2,593,000 in the 3 months ending the 30th of September 2025, down from $29,551,000 in the same period of 2024. This is a positive sign, especially coming from lower incentive compensation accruals this year. Even with slightly lower sales, they managed to keep these overhead costs in check. And all these changes in sales, cost of goods sold, and operating expenses led to a much better operating income for the third quarter of 2025. They reported an operating income of $945,000, a significant improvement from an operating loss of $467,000 in the same period of 2024. This shows that the company is becoming more profitable on its core operations. However, when we look at the 9-month period, the overall operating income is still lower than the previous year, mainly due to the drop in net sales, but the trend in the recent quarter is certainly a step in the right direction. Let us talk about the company's order book, which shows what they expect to deliver in the near future. As of the 30th of September 2025, their 90-day shipment backlog was $31,322,000. This is a pretty good increase of 17.8% compared to the beginning of that quarter. It is also a 5.7% increase from the same time in 2024. This indicates that customers are continuing to place orders for upcoming deliveries. Their total order backlog as of the 30th of September 2025 was $77,292,000. While this is a small decrease from the beginning of the quarter, it is a healthy 10.8% increase compared to the same period in the prior year. The growth here is largely driven by an increase in orders from the aerospace and defense sector, which, despite recent sales dips, seems to be picking up again for future business. Now, let us turn our attention to the company's balance sheet, which gives us a snapshot of their assets, liabilities, and shareholders' equity at a specific point in time. As of the 30th of September 2025, Nortech Systems had total assets of $74,757,000. This is up from $72,435,000 at the end of 2024. Their cash position has improved, standing at $1,271,000 compared to $916,000 at the end of last year. That is a good sign of increasing liquidity. However, the company has taken on more debt. Their current liabilities show a line of credit of $12,000 and $30,000, whereas at the end of 2024, there were no outstanding amounts on their current line of credit. This increase in debt is something we will need to keep an eye on. Overall, total liabilities have increased from $38,430,000 to $41,000. Shareholders' equity, while still substantial at $33,357,000, has seen a slight decrease from $34,000 at the end of 2024. This is primarily due to the net losses reported for the 9-month periods. The retained earnings specifically declined from $17,375,000 to $16,226,000. Looking at the earnings per S-share, it is not pretty for the 9 months ending the 30th of September 2025. They reported a basic loss per S-share of $0.41. In contrast, for the same period in 2024, they had a positive basic earnings per S-share of $0.07. This shows a significant drop in profitability on a per share basis this year. As you might expect with higher debt, their interest expense has also gone up. For the 9 months ending the 30th of September 2025, cash paid for interest was $740,000, a rise from $531,000 in the same period of 2024. The company's financial health and ability to keep operating are heavily tied to its financing arrangements. Nortech Systems has a senior secured revolving line of credit with Bank of America. This credit line has been amended several times, which tells us they have had to make adjustments to meet its terms. They were not in compliance with some financial covenants in the first half of 2024, but they managed to get waivers. The line of credit is secured by almost all of the company's assets and is set to expire on the 31st of August 2026. This is a critical date as they have not yet finalized a plan to refinance this debt. This situation raises substantial doubt about the company's ability to continue as a going concern, meaning whether they can stay in business. However, management believes a refinancing to an asset-backed line of credit is probable before the debt matures, and they have received term sheets from lenders. They have also engaged a financial advisor to help with this process. The company has also been undergoing restructuring. In 2024, they initiated a plan to close their Blue Earth, Minnesota facility, and this continued into 2025 with staff reductions. For the 9 months ending the 30th of September 2025, they incurred $266,000 in restructuring charges. While these costs might seem high, they are part of an effort to streamline operations and improve long-term efficiency. Let us look at where their sales are coming from geographically. The United States is still their biggest market, accounting for $18,170,000 in net sales for the 3 months ending the 30th of September 2025. However, sales in the US have decreased compared to 2024. On the other hand, their sales in China have seen a significant jump, reaching $5,233,000 in the same period, up from $3,496,000 in 2024. This growth in China could be a key area for future expansion. When we break down their sales by market, medical device sales saw a slight decrease this quarter, down by 1.6%. Medical imaging, however, showed a nice increase of 8.7%. The industrial sector saw a small dip, while aerospace and defense experienced a significant 28.3% decrease in sales for the quarter. These fluctuations highlight the varying market conditions they are navigating. Amidst all these financial numbers, there is a significant risk factor worth noting. The company's common stock is trading at a value less than its net equity. Because of this, they had to review their long-lived assets like property and equipment to ensure their value is still sound. While they did not find any long-lived asset impairment as of the 30th of September 2025. They are closely watching this situation. If the fair value of these assets were to drop below their recorded value, it could lead to a material non-cash impairment charge, negatively impacting their financial results and potentially affecting their ability to meet debt covenants. This is a warning sign that their assets might not be as valuable as they appear on paper. Another major risk lies in their credit agreement. As we mentioned, they have had trouble complying with certain financial rules, known as covenants, in their credit line. While they have received waivers so far, future non-compliance could lead to their lender demanding immediate repayment of all outstanding debt. This would be a serious blow to their financial stability. The ongoing amendments to this agreement highlight the delicate balance they are trying to maintain with their lenders. On a more positive operational note, management has assessed their disclosure controls and procedures and found them to be effective. This means they are confident that the information they are reporting in their filings is accurate and timely. That is a fundamental requirement for any publicly traded company. Looking at the bigger picture, Nortech Systems Incorporated appears to be in a transitional phase. On one hand, they are showing signs of improving profitability and operational efficiency, particularly in the latest quarter, with a solid increase in gross profit and a reduction in operating expenses. The growing backlog indicates continued customer demand. However, on the other hand, increased debt coupled with the precarious situation regarding their credit line covenants presents a significant risk. The falling stock price relative to net equity also flags potential asset value concerns. The company is actively working to refinance its debt, which, if successful, could alleviate some of the immediate going concern worries. The growth in their Chinese market is a positive strategy, but the overall revenue decline and the significant drop in the aerospace and defense sector are areas that need careful monitoring. It seems like they are doing what they can to navigate a challenging environment by cutting costs and optimizing operations, but the debt situation is a major overhang. Alright, that is our breakdown of Nortech Systems Incorporated's latest filing. What is your take on these numbers and what they signal for the company's future? Do you think their refinancing plans will be enough to keep them afloat? Drop your thoughts in the comments if this analysis was valuable. Hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.